stop. Just stop what you're doing and listen. I just got the reports. China's largest banks, including the world's largest, ICBC, are out of physical gold bars. They are actively redirecting customers to buy silver. Right now. And while that is happening, physical silver in Shanghai is trading for over $100 an ounce. But the paper markets in New York are trying to tell you it's worth 82. You see the disconnect? This isn't an anomaly. It is the terminal symptom of a physical drain we have been tracking for months. This price gap didn't just appear. It's the fever spike from a fatal condition in the vaults. To understand what's coming, we have to go to ground zero. We have to examine the hard withdrawal data that shows exactly how this physical endgame began. Ground zero is the Shanghai Gold Exchange. The hard withdrawal data is in, and it confirms our worst fears. First, understand what an SGE withdrawal is. This isn't inventory shuffling. It's not a bar moving from one vault to another. An SGE withdrawal is consumption or permanent removal. That metal is gone, melted down for industry or put into a private vault, never to return to the market system. It is a final act. Now, the numbers. In the first 2 months of this year, 2026, a record-shattering 536.8 tons were withdrawn from the SGE. To put that in perspective, January alone saw 321.7 tons pulled out. That is a 287% increase over the same month last year. This isn't an uptick, this is an explosion. When you chart this data, the bar for January 2026 doesn't fit on the same chart as the others. You'd have to rescale the entire axis. This is a total statistical breakout, a paradigm shift happening in real time. Let's connect the dots forensically. We saw the banks run out of physical gold. That was the trigger. The record-breaking SGE silver withdrawal is the effect. What we are witnessing is a forced substitution from gold to silver on a national scale. The demand is so ferocious, it's spilling over and draining the next most valuable physical asset at a rate we have never seen before. The physical reality is overwhelming the paper narrative, and the clock is ticking. The combined silver inventory left in the Chinese exchanges, both the SGE and the Shanghai Futures Exchange, has now fallen to a critically low level of around 800 tons. At the current rate of industrial consumption in China, that is just a few weeks of cover. Weeks. The drain in the east is a confirmed hemorrhage. We have the intel. But this is a global fight. Focusing only on China is a strategic error. What is happening in the vaults of the West, at the very heart of the paper market itself? Ignoring that front would be a fatal mistake. The answer is, it's the same hemorrhage, but this time it's at the very heart of the paper system. The COMEX, the drain in the east, is mirrored by an equally alarming bleed out in the west. This isn't a separate fight, it's a synchronized global squeeze. To understand the threat, you have to understand their battlefield. The COMEX has two main stockpiles, eligible and registered. Forget eligible. That's just silver sitting in a warehouse that could be sold. Registered is the only inventory that matters. It's the metal that is legally available right now to satisfy a delivery contract. It's the ammunition in the magazine, ready to fire. Everything else is just noise. And that magazine is running empty. I just pulled the latest CME Group data. As of early March 2026, the registered stockpile stands at just 88 million ounces. 88. That's a 31% drop in total inventory since October of last year. This isn't a slow leak, it's a gaping wound. But here's what this really means. Look at the March 2026 delivery contract. Buyers stood for delivery of over 52 million ounces of physical silver. 52 million in a single month.
Now do the math. Your frontline supply is 88 million ounces, and 1 month's demand just claimed more than half of it.
This is why the system is screaming. The depletion rate is a steady 20 million ounces per month. That represents nearly 30% of the entire planet's monthly silver mine production being vacuumed out of one single exchange. The vaults are draining faster than the mines can produce. The paper promises are being called in, and the physical reality is that the shelves are going bare. This is the endgame for paper price suppression, so you've seen the drain in the east and the drain in the west. Which one do you think is the real dagger to the heart of the paper market? China's hidden consumption, or COMEX's visible depletion? Vote China or COMEX in the comments below. Let me know which front you're watching. But as you think about that, you need to understand one final critical piece of intel. This coordinated global drain, it isn't random market noise. It's not just a collection of individual buyers. The data signature points to something else. Something engineered. A quiet, calculated silver war being waged by a state-level actor. And if you want to understand how deep this goes, you need to know why someone like Elon Musk is terrified of exactly this scenario. That state-level actor is China. And the war began on January 1st, 2026. Here's the intel. On that day, Beijing officially reclassified silver as a strategic national resource. They didn't just talk about it, they acted. They implemented a strict one order, one approval export licensing system. And get this, only 44 companies in the entire country are even allowed to apply for a license. Here's what this really means. The West's access to Chinese refined silver just got choked off. The most conservative projections show this move will slash their exports by 30 to 50%. That is a sudden, annual shortage of approximately 2,000 tons ripped out of the global supply chain. Gone. Let's be perfectly clear, because this is the aha moment. What China is doing to silver is exactly what they did with rare earths. They are weaponizing a critical resource. This isn't a market fluctuation. It's a calculated move in a new Cold War for industrial supremacy. They are hoarding silver to secure their absolute dominance in solar manufacturing, in electric vehicles, and in their defense sector. This single government action is the hidden engine driving everything we've been tracking. It's the reason the Shanghai silver premium exploded, hitting a spread of $9.38 an ounce. That's a 12% premium over Western prices, because the physical metal is now trapped inside their borders. This is why the rest of the world is being forced to drain Western vaults like the COMEX at this accelerated, desperate rate. They've cornered their own supply, so everyone else has to raid ours. And don't just take my word for it. The moment China made this move, the world's largest industrial consumer of silver, Elon Musk, sounded the alarm. On December 27, 2025, right after the policy was announced, he posted on X, and I quote, "This is not good. Silver is needed in many industrial processes." He knows this isn't a theory from some analyst. It's a direct, immediate threat to his supply chain. A threat to Tesla, a threat to SpaceX, a threat to the future he's building. Now, as this reality sinks in, the apologists and the paper pushers will rush to tell you one thing. They'll tell you not to worry. They'll claim that new solar panel technology will reduce silver consumption. That substitution will save the day. They will present this as the ultimate bear case for silver. But what they don't understand, and what I'm about to show you, is why that substitution argument is actually the single most bullish signal for physical silver we have ever seen. And here's how we know. Let's tackle their last line of defense head on. The talking heads, the paper apologists, will tell you that the solar industry will simply switch to copper.
That silver demand is about to crater.
Here is the engineering reality they conveniently ignore. The dominant solar technology, TOPCon, is on track to be 70% of the market by 2026. For TOPCon, copper substitution is a catastrophic failure. The high-temperature process required for these advanced cells causes copper atoms to diffuse, to bleed into the silicon wafer. This contamination permanently destroys the cell's efficiency and its lifespan. This isn't an economic debate, it's physics. For the vast majority of the future market, copper is a non-starter. But let's look past the science for a moment and focus on the numbers. The silver market is now in its 6th consecutive year of a structural supply deficit. The Silver Institute just reported record industrial demand of 680.5 million ounces in 2024. The engine of this deficit is accelerating, not slowing down. This substitution fantasy is a meaningless distraction in the face of a real, physical drainage that is happening right now. Now, for the final, intellectual checkmate. The fact that these multi-billion-dollar corporations are frantically burning fortunes to research a silver substitute is the single greatest confirmation of our entire thesis. Think about it. You don't spend billions of dollars replacing something that's cheap and plentiful. You do it because your internal forecasts, the ones they don't show the public, are screaming that silver is becoming critically scarce. You do it because you know its price is on a trajectory to explode. Their desperation makes perfect sense. Look at their own costs. Silver's share of a solar panel's production cost has already ballooned from a mere 3% in 2023 to between 17% and 29% today. They are bleeding cash. Their panic is our proof. The bear case and the bull case are feeding each other. This entire substitution narrative is a sideshow. They want us fighting over panel chemistry while we ignore the fundamental geological mispricing of the entire monetary system. There's a number, a simple ratio that has governed precious metals for centuries. A number the bankers pray you never understand. Because if you did, you'd see exactly how disconnected today's paper price is from physical reality, and that is precisely where we are going next. That number is 8-1. For every single ounce of gold wrested from the Earth's crust, geology gives us 8 ounces of silver. That is not an opinion. That is a physical law. The Silver Institute's own survey data confirms it. Global mine production is roughly 820 million ounces of silver against about 110 million ounces of gold. Do the math. It's the law of the planet. Now, look at your trading screen. What does the paper market, the casino, tell you? 62-1. Let that sink in for a second. In the ground, the ratio is 8-1. On the trading screen, it's 62-1. One of these is physical reality. The other is a paper illusion. This, right here, is the proof we have been right all along. It is the fundamental disconnect. Here's what this really means. This isn't a minor pricing error. This is an 88% discount to geological reality. The market is pricing silver as if it's nearly 8 times more abundant relative to gold than it actually is. It is a valuation structure with a cracked foundation. And for anyone who tells you it's always been this way, they are fighting the last war. The old rules don't apply. This isn't 1980. Silver is no longer just gold's little brother, a secondary monetary metal. It is an irreplaceable industrial component being consumed into oblivion, gone forever. We are in the 6th consecutive year of a structural supply deficit because every solar panel, every EV and every smart device is eating physical silver faster than we can mine it. That's why this 62-1 ratio isn't just an anomaly, it is a historic mistake. A mistake on a collision course with a forcible correction.
The question is no longer if. This paper illusion will shatter against physical reality. The only question is when. And that collision, that moment of violent repricing, isn't some far-off hypothetical. It has a deadline. It's an unavoidable event on the delivery calendar that will force the hand of the manipulators. Keep watching, because I'm about to show you exactly why all eyes must be on April 30th. April 30th. This is the forcing function. It's the specific, unavoidable event on the calendar that will compel the paper market to finally face physical reality. Because on that day, the delivery process for the massive May COMEX futures contract begins. Every paper promise comes due. To understand the magnitude of what's coming, you have to see the tale of two markets playing out right now. On one side, you have the paper market. The price on your screen might say $82. It moves on whispers of macro news and algorithm triggers. It is an abstraction. On the other side, you have the physical market. The world of steel vaults, shipping containers, and factory floors. In this world, the Shanghai Exchange is paying a premium of $7, $8, sometimes $10 or more over that paper price. In this world, COMEX vaults are draining at a terrifying rate. These two realities cannot coexist forever. April 30th is the day they collide. Now, for the terrifying math, the COMEX registered inventory, the actual metal available for delivery, is in a nosedive. We are plunging toward the critical 50 million ounce level. The drain rate is relentless, around 650,000 ounces walking out the door every single day. This thin layer of physical supply is the only thing backing the entire paper charade. And what is it up against? The upcoming May COMEX contract. As of now, it has over 400 million ounces of open interest. 400 million ounces of paper claims set to begin the delivery process on April 30th, all demanding settlement against a registered inventory that is vaporizing before our eyes. The open interest for this single month is potentially 4 times larger than the entire deliverable supply on the exchange. The divergence is absolute. As the saying goes, when paper and physical diverge by that amount, one of them has to move. April 30th answers that question. So what is the ultimate risk here? This isn't just about a price spike. This is about the integrity of the entire system. It's a bank run on the vault. On April 30th, the customers, the contract holders, show up to withdraw their money, which is silver, but the vault, the COMEX registered inventory, is nearly empty. They can't deliver. They physically do not have the metal they owe. That's a settlement failure. That's when the game ends. That is when the paper facade shatters, and the true price of physical silver is revealed, and that moment is no longer a possibility. It's an appointment on the calendar. Let's retrace the path. We started with the banks being out of gold in China. We followed the physical drain right to the COMEX vaults. We uncovered the silver war being waged by a superpower. And now we have the date where the paper market must answer for it all. Understand this. The market disconnect we are witnessing is not random noise. It is the direct, audible result of draining vaults, a historic mispricing, and a physical reality that is about to overwhelm a paper illusion. Physical law will assert itself. The COMEX delivery deadline is simply the forcing function. The appointment is set. There is no escape hatch for a lack of inventory. For everyone who has watched the data, who has trusted the numbers over the narrative, this is your proof. The data confirms you weren't wrong. You were just early. The coming correction isn't a market crash. It is a return to reality. It is your vindication. This isn't speculation anymore. It's an inventory problem with a deadline.
The vindication for those who trusted physical reality is arriving. If you want to watch every step of this final countdown, make sure you are subscribed with notifications on. You will not want to miss what happens next.